Hello everyone and welcome to this month's webinar. Today we're going to be talking about bucket companies and holding companies. And is there a difference, or what is the difference? Get this question a lot, particularly with companies that they start expanding and they need a little bit more corporate structuring. So we'll go through what each of those are today. Just before we get started though, make sure you get your own independent advice before you do anything too crazy. That's me, I'm Derek Nolan. I'm the owner of 12 Chartered Accountants. Been doing these videos for a long time, so make sure you check out all the other ones that I've been doing. So I'm going to go through a bit of a refresher here and just talk about trusts in companies. So if you've got a business being, a reasonable size, you're sort of asking those questions, or you know about restructuring and what you should be doing to sort of maybe save some tax and make a bit of asset protection. But a lot of the fundamental questions comes down to company or trust or company. So this is where holding companies and bucket companies and that all fit into the structure. But we've got to just go through a bit of old ground first. I've said this in all my videos. The reason you have companies is for asset protection purposes. That's what it's all about. If you've got a company in place and anyone tries to sue your business, they'll sue your company and your house will be safe. Obviously, there's some issues regarding director penalties and being a director of a company, but most times, as the owner of a business or owner of a company, you'll be safe. It's the company that gets sued. Mind you, there's a whole issue then about creditors taking the assets of the company. So we'll get to that a little bit later. So that's what I basically fundamentally say all the time, is that's what companies are for. Where trusts are there to reduce tax. If you have humans, I always talk about family trusts. I've done plenty of videos on this in the past. I'll show you a link later. But trusts are there to save tax in Australia, but you still need the people to be able to use to save the tax. I'll go through a couple of examples of that later. But I've always said that in all my videos, and that's sort of fundamentally true. So a quick refresher though on how you run a business through a family trust. And I'll go through also the other option with the company in a minute. But with a family trust, like I said, the main reason it's there is to reduce tax. And how does it reduce tax? Well, you have beneficiaries that share the income. I'll go through an example in a sec. Now, trusts don't pay tax, different to a company. The beneficiaries of the trust pay the tax. So if the trust has a profit, it must distribute that profit to the beneficiaries, who then pay the tax. So in a lot of situations, the beneficiaries are individuals, so they end up paying tax in their personal tax returns. That's sort of how a family trust works. A lot of people get a little bit confused, particularly in other countries. If they watch videos from America and the UK, trusts, and even New Zealand, trusts are treated a lot differently in those countries. Now, I did a video a while ago. It's been a very popular one on what is a family trust and how you can basically use it to save tax. So if you haven't watched that one, I do recommend you go back and find that one, either on my website or on YouTube. So here's the quick refresher course though. Let's say you got a family trust. I won't go through the details about trust deeds and settlers and all that sort of stuff. But one thing you do always need is a trustee. And most of the times I will recommend having a company as the trustee. Like I said, family trusts won't give you the asset protection, but having a company as the trustee will do that for you. But the basic structure then, particularly if you're running your business through a family trust, like I run my business here through the Nolan Family Trust. So 12 Proprietary Limited is just the trustee company of the Nolan Family Trust. So if you get an invoice from me, it's actually from the Nolan Family Trust. That's the ABN number, that's the bank account, everything runs through the Nolan Family Trust. And the basic structure of a family trust, you have beneficiaries. So I've always talked about this before. The trustee is like the parent and the beneficiaries are like the children. The parent looks after the running of everything, looks after all the assets on behalf of the beneficiaries or the children. But ultimately, the owners of the business are the beneficiaries. And they're the ones who are entitled to the income. Now, under a family trust, which is really a discretionary trust that's made a family election, it's completely up to the trustee on who gets the income. So I've got William, Anita, Derek, and Richard as my family. The distribution from the family trust can go to any of those people, and there's probably more. I've got my parents, my auntie and uncle, my niece and my nephew. All those other people are potential beneficiaries. But it's completely up to the trustee on who that income goes to. Now, when I say that, it's normally the trustee with the help of their accountant is usually how the distributions go. So let's just say an example here. Let's say the family trust, the Nolan family trust, has a $360,000 profit for the year. Now, I'm not going to go into the details about how that $360,000 came. Sometimes some of these people get paid a salary, but usually not. If you're getting distributions out of the trust, it's much easier to take it as a distribution as opposed to a salary, because a salary has the whole single touch payroll, superannuation, payroll tax, PAYG, and all those other things that go with it. So most people that run their business through a family trust, at the end of the day, they just take drawings out during the year. And at the end of the year, on the 30th of June, they make a declaration, and this is what the actual distributions are. So in this example here, we've got $360,000. If you watch my videos before, it's in the bucket. You've got this bucket of $360,000, and on the table in front of me, I've got four glasses. Some of them already filled, like if William's already got a part-time job or Anita's got a part-time job, they might already have some money, and I sort of tip it in and all that sort of stuff. You'll watch one of my old videos on that. But this situation, I thought I'd make it really simple for all my examples, is that William, Anita, Richard, and Derek don't have any other income. So it's just going to make it nice and simple. What usually would happen then is you make a distribution of $90,000 each to William, Anita, Derek, and Richard. So the whole $360,000 is distributed. You can't not distribute money. If it is, then it's taxed at the trustees level at 47%. So you must do the distribution. Now, if you work out the tax on $90,000 for any person, now that's the other important thing, was the beneficiaries need to be over the age of 18. So William and Richard are at uni, so they're over the age of 18. So the tax on those $19,588, that's on the 2024-25 numbers. So the total tax that the Nolan family will pay is $78,352 on that $360,000 profit. Now, obviously, I'm trying to make it simple there. Like I said, Anita and William, Richard have probably got part-time jobs and things like that, so it messes it all up. But this example was assuming they didn't have anything in their tax return to start with. So that's sort of how family trusts work with a number of beneficiaries. But like I said, the more beneficiaries you have, the more you can save by spreading the income around. But if you don't have any beneficiaries, you really can't save too much in the way of tax. This is where a bucket company then comes into play. So the whole topic of today is talking about what a bucket company is. Now, a bucket company is another company that, I won't go into the technical side of it, but if you've got a company that is controlled 100% by one of the beneficiaries, and the trust makes this interposed entity election, big word, but basically it says that if one of those beneficiaries also controls a company, well, that company can also be a beneficiary of the family trust. It doesn't need to be a human. So that's a really important concept, and that's what bucket companies are all about. And most of the time, a bucket company just got set up yesterday. It's never done anything. It's just a company that's controlled by one of the beneficiaries. But sometimes, someone's had a company for a while, particularly maybe Anita had a business in the past that she ran. So she's already got a company. Now, maybe that company's already got losses in it, which is very interesting. And that's why it's very interesting to talk at Christmas time to all the family members if anyone's got any bucket companies that they don't need or have got losses in them. So But yeah, that's what a bucket company is. It needs to be controlled by one of the beneficiaries 100%. Can't be 99%. Has to be 100% by one of the beneficiaries. And that becomes a potential beneficiary. It's like having another child, which is fantastic. So in this situation, let's say we've got that $360,000 to distribute, and we go William $45,000, Anita $45,000, Derek and Richard all $45,000. Now, the key to the $45,000 is that's where the 16% tax bracket stops. So if everyone understands how personal tax return or tax rates work, the first $18,200 is tax-free. From $18,200 to $45,000 is only taxed at 16%, and the bit over that is then taxed at 30% plus Medicare. So that's why $45,000 is a key number, because you're not paying a lot of tax on $45,000. But like I said, the trust must distribute all the profit. So if you're only given $45,000, that's $180,000 to the humans. You then can give the difference, the leftover, to the bucket company. And in a way, it comes from my videos where I talk about having this jug of profit, a jug of $360,000, and you tip it into William's glass, Richard's glass, Derek's glass, Anita's glass, but you've still got money left over. So what you do is you tip it into the bucket company. I think that's where the term sort of came from. It's the leftover bit. Now, the reason you do that is because of the tax that the bucket company pays. So as I said, for an individual to earn $45,000 a year, they only pay $4,488 in tax on that $45,000. So slightly less than 10%, because like I said, the first $18,000 is tax-free, and the next portion is at 16%. So it averages out around 9.5%, 10%. A company has a flat rate of 25% or 30%. I'll go to the reasoning for the differences in a second. But in most situations where people are watching this video, we're in the small business category, turnover less than $50 million. So most of the time it's going to be at 25%. I'll explain when you use 30% in a second. And the great thing about that is it's 25% from the first dollar to the last dollar. So if the bucket company makes a $10 profit, it pays tax at 25% on that $10. If it makes a $180,000 profit, it pays 25% tax on all of that. So that's the way it works. So as a result, if the bucket company gets $180,000, the tax on that is only $45,000. So therefore, the total tax is then only $62,952. So a significant savings if you have the bucket company. Now, this is all about numbers on a bit of paper, and the reality is that you might need that $360,000 in your own names to live on. I get all that, but we'll go through an example of how it actually works later on. But this is why a bucket company is used, is because of the low tax rate. Particularly in this example, it's not a lot, but you could be having a situation where you don't have a lot of humans. You might be just one or two of you, and you might be able to pay yourself up to $135,000, where the 30% tax bracket stops. Because really between 30 and 25 is not a big difference. But once you go to that $135,000 for an individual, you start getting to those high tax brackets, the 39, the 47%. It starts to hurt a lot there. So that's why a bucket company may become very attractive at those higher tax rates. So just compared to what the original calculations without the bucket company of $78,352, so it's quite a significant tax savings there for using a bucket company, and that's what it's all about. So basically, why use a bucket company? Well, like I explained, is it has that lower company tax rate of 25% if it's an active business. Now, should have sort of said, like, the Nolan Family Trust is an active business. But a lot of people have family trusts that are passive. They might have investment properties. They might just be investing in shares and crypto and other things like that. That's when you have the 30% tax bracket. So if you're making distributions out of a family trust, which is not active, going to a bucket company, they'll be taxed at 30%. The other important thing is that the money has to be physically paid. It's not just a thing your accountant does at the end of the year and shuffles numbers on a bit of paper. Well, he does, but you still have to then, after the end of the year, you have to move that money to the bucket company. So say in that example there where the bucket company gets a $180,000 distribution. Now the tax office says that's fine to not have done that on the 30th of June. Because at the 30th of June, if you make a declaration that's going to go to the bucket company, you can still make the distribution of physical money afterwards. So it sort of shows as a loan to start with, but then when the money physically goes to the bucket company, it sort of clears that loan. The tax office really sort of give you 12 months to do that. Otherwise, there's Division 7A issues and things like that. But the great thing about that is, like I said before, if you're running a business, even through a trust with a company as the trustee, it gives you asset protection. However, someone can still sue your business. And if you've got $180,000 sitting in your bank account, they can take it. The tax office can take it. Your creditors can take it. Anyone can take that money. So what you want to do is to physically separate your assets, which is a lot of situations is cash, out of your operating bank account somewhere else. And making a distribution to a bucket company and physically putting it there is a really good way of doing that. So you physically move it out of the trust bank account into the bucket company. And you have to do that anyhow. The tax office sort of asks you to do that. Now, if anyone sort of understands what I'm talking about here, what I'm really doing here is I'm kicking the tax can down the road. Because everyone's saying, well, that's a great idea, Derek, that you've now got $180,000 in the company's bank account. But how can I use that? Well, the answer is you can't, because it belongs to the bucket company now. And if you do want to use it, you've got to then pay a dividend from the bucket company. And by taking it out of the bucket company, you end up paying tax at your tax rates. So what a bucket company really is just used for is, one is to pay the lower tax now and park it into a bucket company to be used later on, like you're kicking the tax can down the road. That's all the bucket companies do. It's nothing special. I've watched videos of other people saying how wonderful this is. Like I said in my example here, instead of paying $78,000 in tax, you're paying $62,000, but that's now. Well, how do I get it out later? And there's various ways of doing that, but mainly you're looking for an opportunity at a later date when maybe you've got a 15, 16, 17-year-old children who will be turning 18 in 1, 2, 3 years' time. Perfect. You can't pay them a distribution out of the trust now, but when they turn 18, then you'll be able to pay a distribution out of them then and use them then. So really just delaying it. Or like we had for the last few years, the tax rates were coming down at the 1st of July 2024. So sometimes it was better to park the money into the bucket company and then take it out when the tax rates dropped. Or maybe someone's looking at retiring soon, so therefore in a few years' time, their personal tax return will be much less, so therefore they can take the dividends out then. So that's what having the bucket company is all about. And like I said, so the money has to be physically paid into a bank account of the bucket company. So one of the first things you need to do is to open up a bank account in the name of the company. And you have to do this. And you really need to do that within 12 months because the tax will say if it's there and still as a loan going to the next year, there's Division 7A issues. You have to start paying interest on it and paying it back and all that sort of stuff. And the other thing too is the bucket company has to pay tax on that. So if you make a distribution of $180,000 to the bucket company then has to lodge a tax return and pay tax on that, which is probably not until May the following year. When most small business tax returns are due, but it has to pay its own tax. So like I said, that $45,000 tax needs to come out of the $180,000. So put the $180,000 into the bank account to tick that box, and then the $45,000 has to come out of that to the tax office. That's the way it works. And like I said, then you've got that, you got $135,000 sitting in the bucket company. Well, if you want to take that out, you've got the franking credits, which is the tax that's already been paid. So you pay a franked dividend out of that bucket company, and it goes in your tax returns. You pay the tax on it, but you do get the tax as a credit once you take that money out as a dividend. That's how it sort of works. Like I said, the family trust must make this interposed entity election, which means that someone who's already a beneficiary. Now, most family trusts or discretionary trusts have made a family election, which means that you only need to nominate one key person as the beneficiary and all their family members are potential beneficiaries. I've done videos on that before. Then the second thing is this interposed entity election, which then connects any companies that are 100% owned by these beneficiaries to make them also a beneficiary. So those things need to be done. We're having a bit of a review in the office at the moment. There's a few trusts we set up that haven't done those interposed entity elections, so we're doing those and backdating them a bit. One thing's important though, you need to look at who the owners of these bucket companies are, because it has to be 100% controlled by a beneficiary. It can't be 100% controlled by two beneficiaries. I know it's a bit of a technical issue, but that's just the way the rules work. And the other thing too is the shareholder of that bucket company, it's very difficult for that to be the same family trust, because a lot of people say, well, hang on, to get the money out of the bucket company now, how am I going to do that? It has to go to the shareholder. So if Derek Nolan is the shareholder of the bucket company and we want to get that money out later, well, it just goes to me. Well, that's not a good idea. The whole plan should go through a family trust again and be distributed to the family members. Particularly those 16, 17-year-olds become older. So a lot of people go, oh, that's fine, I'll just use the same family trust. The tax office don't really like that, because what sometimes you happen is you've got the family trust and then you got the bucket company that the family trust makes a distribution to the bucket company. Now, if the bucket company shareholder is the same family trust, it can then make a dividend distribution or dividend back to the family trust, who can pay it back to the bucket company again. So all of a sudden it goes in and out like this washing machine. And some people have used this to avoid the Division 7A issues. They just constantly do this. So the tax office don't really like that. I mean, if you're not doing that, that's fine. So you can have the original family trust be the shareholder of the bucket company. But that's sort of something that can be set up at a later date. I won't go into too much detail now. Anyhow, my final word on a bucket company is the bucket company are exclusively used with family trusts. So to answer the question, well, what is a bucket company? I think I've explained it there. It's one of those things that if you've got a family trust, a bucket company is an add-on as a potential beneficiary, and it can only be used in that situation where you've got a family trust. That's what it's all about. Holding companies are a bit different. I'll go through that in a sec. Just as a side thing, using the bucket company as an example, again with the family trust, it's very common for people to run their business through a company, not a family trust. Like I said, my business here, the Nolan Family Trust, is my operating entity. A lot of people just have a company. It's probably more common than it used to be, particularly the company tax rate dropping down to 25% for active businesses. So a lot of people come to me and they've just got a normal proprietary limited operating company, which is fine. And the reason they're doing that is for asset protection purposes. And a lot of people are just getting the money out through a salary. Pretty simple, nothing too complex. But I always ask them, well, who's the shareholder of your company? And they say, well, I am. Great. Well, that's nice and simple, because they understand that, companies, they have income, they have expenses, they pay them a salary. At the end of the day, it's not too much of a profit left over, so they don't really need to worry about dividends and things like that. But the problem with this situation is, if you've got an example there, we got that $360,000 profit, and you want to get that money out of the business, you sort of pay the tax first and take it out as a dividend. And that's the way it usually works. So in this situation here, the same, you've got $360,000 profit. The company tax rate is a flat 25%, like we talked about. So it has to pay $90,000 on that profit. So therefore, there's $270,000 left over. But the shareholder wants to get that money out, particularly if they haven't been drawing a salary. Like I've talked in my other videos about a salary strategy and a dividend strategy. I particularly like the dividend strategy to get the money out of your business because it doesn't attract as high a workers' comp. It doesn't attract payroll tax. There's no PAYG. There's no superannuation. There's no single touch payroll. It's much simpler to get money out of your business as a dividend as opposed to a salary. So a lot of people are moving to that strategy. It's much easier. The problem though, when the money comes out as a dividend, it can only go to the shareholder, which in a lot of situations is just the one person. So what happens then is the dividend, the $270,000, gets paid to the shareholder with the franking credits. The tax has already been paid. Now that gets grossed back up to $360,000, and tax on that is $135,000, but you get the franking credit. So the individual has an extra tax of $45,338 to pay in this situation. So therefore, you end up paying the $90,000 by the company and another $45,000 by the shareholder. So the total is $135,000 in tax, which is a lot of tax. So if you're just a sole trader running through a company, you've got a problem if you don't have enough humans. This is what it's all about, is having humans. Otherwise, you pay a lot of tax. Sure, you're paying tax at the 25%, but you end up paying a lot of it at the 47% tax bracket in your own name. So what I suggest to a lot of people is that they change the shareholder from themselves and just stick in a family trust. Pretty simple. You don't need a company to be the trustee of the family trust because you've already got your asset protection down in the operating company. So a family trust can just be nice and simple. Derek Nolan can be the trustee, do the family trust election, and replace yourself with a family trust as the shareholder. Then all of a sudden you've got the same situation. You've got all the beneficiaries that you can use along with the bucket company. So this is another option for people that have already got the operating company and they want to get the money out and save some tax using a family trust. And this is sort of a common thing. And in my videos, I also talk about if you're the shareholder of the company, well, you've got asset protection from whatever the company does, but in a lot of situations, the company doesn't have protection from you. So say, for example, you have personal debts and you get sued or, divorced or something. All of a sudden, the company and the shares you own directly could be your biggest asset, particularly if the company's worth something. So therefore, if you owe money to someone and you say, oh, listen, I don't have any money, they'll just come along and take your company or take all the assets to the company. So in a lot of situations, you being the shareholder is not a great idea. But a family trust owning the shares, you don't own the shares beneficially. The family trust does on behalf of all the other beneficiaries. So therefore, your shares are a lot safer then. So a lot of people just do that for asset protection purposes anyhow, let alone the tax savings. So in this situation here, similar situation, you've got the company pays the 25% tax first, which is different to the other example where the bucket company was the end result. So in this situation here, you've got the tax is already paid at $90,000. So therefore, you've only got $270,000 to distribute because the 90's already gone to the tax office. So in this situation, splitting that 4 ways between William, Anita, Derek, and Richard, it will be $67,500 each. But the wonderful thing about franking credits is they flow through to the individuals at 25%. Now, in that situation, you've got William and Anita and Derek and Richard, their taxable income is $67,000, but some of it is 0%. first 18,000. Then there's some of it at 16% and some of it at 30%. So on average, it probably works out around 19-20% tax. But 25% has already been paid by the company. And when those dividends flow through, the individuals get a refund. And that's what's happening in this situation here. Each of us get a refund of $2,912. So the total refund becomes $11,648. So the company pays the $90,000 first to the tax office. And this is what I always say. The tax office says, listen, you pay the company tax and they'll hang on to it and keep it safe until you pay a franked dividend that goes to the shareholders, and then they can get the credit and offset the tax they have to pay. That's how it works. So in this situation here, you pay $90,000, you get the $11,000 back. So therefore, the net amount you end up paying to the tax office is $78,352, which happens to be exactly the same amount of tax in our first example. Remember, if going back there was just the straight family trust, the same amount, $78,352. Amazing stuff. So a lot of people will do that. So you can operate your business through a family trust or operate through a company. Getting the money out, you end up paying exactly the same amount of tax. It's just a different way of doing it. As an operating company, you pay the company tax rate first, and then you get it out as a credit later. And sometimes, if you've got enough humans, you get some of a refund. So some people go, oh, better get the tax returns done nice and early this year. But if you're just running it through a family trust with enough humans, you end up paying the tax at a later date. So maybe you'll lodge your tax returns later. It all comes down to a bit of timing there, but exactly the same amount. So just going back to our friend here with the operating company as the shareholder. So I think one thing I didn't mention then, we'll just go back a sec, is the bucket company there. The tax office says in this situation, the operating company is taxed at 25% because it's a small business under $50 million and it's an active business. It's not a passive income. So therefore the tax is 25%. Now, like before, when it was the family trust that was running the business and it made a distribution to the bucket company, the bucket company was taxed at 25% because it still has the characteristics of where the money was coming from, which was the family trust. So therefore, it was only taxed at 25%. What the tax office says here, if the bucket company is more than once removed, so therefore what you've got here is the dividend goes from the operating company to the family trust, then from the family trust to the bucket company, that's twice removed. They say, hang on, that bucket company now is a passive investment company. It's too far removed from the actual operating entity. So therefore the bucket company would be taxed at a flat 30%. So it changes the calculations a little bit. So therefore, like I said, William, Anita, Derek and Richard, once they go over $45,000, they're in the 30% tax bracket anyhow. So therefore, whether it goes to them up to $135,000 or goes to the bucket company at 30%, there's no difference. I think the difference is Medicare for a couple of percent. But really, at the end of the day, that's not too much. So the bucket company in this structure isn't really relevant. You can have it there if you're in the high tax brackets. So if you're pushing up well over $500,000 a year, you've got a couple of people to make the distributions to, bucket company can still work. Because the alternative is to leave the money in the operating company and not pay a franked dividend. You don't have to. But the whole purpose of that is, well, you've got an issue then with having all the money sitting in your operating company at risk. Okay, so that's what that was all about. So just jumping forward here, we've got our mate here who's running through an operating company. He's the shareholder. Before I said, how about putting that into a family trust, the shares in the operating company owned by a family trust? An alternative is, instead of going through a family trust, is to have a holding company. And this is where we start the video talking about what a holding company is. I think we've killed on what a bucket company is. Now, a holding company owns the shares in the operating company. It's just another proprietary limited company owning the shares in another proprietary limited company. And the reason you do that is mainly for asset protection, because the operating company gives you plenty of asset protection anyhow. But like I said, people can still sue your operating company and take the money and the assets that are in that company. The holding company is there for a couple of reasons, but one of them is to move the money out of the operating company up into the holding company where it's safe. It becomes a bit of a cash box company. So therefore, and the way you do that is through a dividend. I'll explain through that an example in a second. So you have this holding company. So therefore, you're moving up there to be safe. And it can stay there for as long as you need it. But one day you'll need the money out, and particularly going through the dividend strategy like a lot of my clients do, we'll still need to get the money out. And that's where the family trust can then sit as the shareholder of the holding company. And you have your normal beneficiaries from the family trust. So this is a very typical situation for clients that have a reasonable size. They've got an operating company that's doing well. There's plenty of assets in that company, including cash. And we're starting to say, well, hang on, what's the purpose of that? How do we get the money and hold it where it's safe? And that's where these holding companies come into place. The other thing I didn't mention is all this restructuring, if your turnover is less than $10 million, can be just done without any capital gains tax issues. If your turnover is greater than $10 million, we need to start thinking about, values of shares and things like that. So therefore, if you've got a business that's growing fairly quickly and it's likely to be going over the $10 million fairly soon, you probably need to start thinking about these sorts of things now as opposed to later. That's all. So you've got this structure here, which is a very typical way a lot of my clients set up their business. They've got the operating company, this holding company, which is where you park the cash and the money, and then your family trust to get the money ultimately out to the beneficiaries. So again, if we go through that example, we've got $360,000 in the operating company, and you pay the $90,000 in tax, which gives you $270,000 cash. So imagine if that's all you did for the year. At the end of the year, you got $270,000 in cash, which is at risk every single day of the week. You need to move that into the holding company. And the way you do that is through a dividend. And the dividend obviously gets paid to the holding company as a fully franked dividend. And like I mentioned before, because the holding company is only one step away from the active business, its tax rate is at 25%. So therefore, that $270,000 is declared as income for the holding company. The tax on that gets grossed up. So the tax on that is $90,000, and it gets a credit for $90,000. So therefore, there's no tax. Because that's always the difference, is if you make a distribution, it's the difference that you're paying. So if it goes to Derek at 30% and it's already been taxed at 25%, he pays the 5% difference. But the holding company at the same tax rate, there's no tax on it. So you can move the money from the operating company to the holding company, pay no tax, and it's safe in the holding company. That's how you do it. And then from then on, you make the distribution of the holding company to the family members through the family trust, same as before. So we've got the $270,000, they're getting a bit of a refund there, total tax. So as a result, there is the magic number again, $78,352 is the ultimate you pay in tax. So as you can see, it doesn't matter what structure you've got, the tax is the same going through a family trust. Whether you go to a bucket company, to a holding company, if you've got the same number of humans. So it doesn't really matter at the end of the day when it comes to tax. So just a few points on all that is the operating company makes a profit and pays tax at 25%. That is paid to the holding company and gets a franked dividend. So therefore there's no tax to be paid on because it's the same tax rate. The bucket company, if in either of those situations, it goes through the holding company, to the family trust, and off to a bucket company, they'll be taxed at 30% because it's more than once removed from the active business. Now, that may still work for you. You may still do that, but most of the time, why do that if you've got a holding company? So the reason you're putting it off there is you're paying tax at the lower rate and you're parking the money there. But once the money's moved out of the operating company to the bucket company, it can stay there. It doesn't need to move on. It's perfectly safe where it is in the holding company. It doesn't need to move on. So this is the reasons why you use a holding company. Well, it's pretty much the same. It's the same as a bucket company. The two fundamental reasons is because the lower tax rate, which is 25%, and the money is physically separated from the operating entity. So really, at the end of the day, what's the difference between a holding company and a bucket company? Not a lot. The bucket company is in the exclusive world of a family trust, though. If you have a family trust, though, you need a bucket company to separate and do those things. If you're running your business through an operating company, it's where you use a holding company, because by the time it goes to the bucket company, you're paying a higher tax rate. So that's pretty much the difference between the two to answer the questions, is the difference between a holding company and a bucket company. However, there's some more advantages from a holding company's point of view. So a holding company, you can have multiple non-related owners. So the first example, which is running your business through a family trust, like I do, I'm the only owner of my business. And it would be very difficult for me to take on other business owners because everything's running through the family trust. I would have to probably restructure everything. Go back to being a company, do a bit of an asset rollover into a company and completely restructure, because it's hard to have a non-family member become a owner of my business. Where the holding company, you can, like it's another company, and there's quite complex structures where you have a holding company and it could be 50% owned by Derek's family trust and 50% owned by Tristan's family trust, if you want to do it that way. And then their family trust go off and do their own things. So holding companies can have multiple owners. So therefore, you'd have different percentages. Like I could even have a holding company where it's 80% owned by me, 10% owned by Sandra, 10% owned by Tristan. Like you do multiple things like that, where the family trust, you can't do anything like that. The other thing about this holding company, it's risk-free, because it's a bit like the bucket company. But the bucket company's all out by himself, doesn't own anything. To get money in there, it's got to go through the family trust. Where the holding company really is an entity that's literally holding cash. And it's ideal to become the family bank. A lot of clients are coming to me sort of getting to the end, and they've got the next generation coming through. And they talk about setting up a family bank which has all the retained profits and stuff, and be able to lend it out to the next generation to help them buy houses and things like that, because going to the bank is quite expensive. So the holding company is ideal for that. The holding company can use for a lot of other things, as long as it's not putting the money at risk. It can go and buy shares in BHP and other things like that, and just become an investment company if it wanted to use the money for other purposes. And the final thing I'm going to mention is the holding company is also known as a parent company. And most public companies have this. Like you have this holding company with lots of different subsidiaries. The subsidiaries can be for different reasons, for different locations. It can be subsidiaries that own the assets of the company, the plant and equipment, and things like that. So as businesses expand, and I've got actually a group of companies here that has 22 different subsidiaries under their holding company. So it can be quite a complex situation, but it's the holding company's the glue that holds everything together. So for example, here you can have this holding company that's just the parent company. It just owns the shares in all the other companies. Now, it may not own them 100%. Most of the time they do, but there's nothing wrong with, selling off one of your companies or, part owned and stuff like that. In this example here, you might have your New South Wales operation, your Victorian operations, your Queensland operations. You might also have another company set up just to own the intellectual property. You might have another company set up just to own the assets, and those assets are then hired across to the other companies. You might have another company that just has the employment company. It has all the payroll tax and the superannuation issues and stuff like that, all contained in one company, and it hires the staff to the other companies. So multiple reasons. The reason you have all that is because you compartmentalize all these different purposes, and it doesn't affect if one company goes bankrupt or gets attacked for various reasons. It can just be cut away and everything else is safe. So that's what holding companies are all about, and parent companies. And some of the other things there is losses can be transferred freely to companies within the group. So if you've got a company over here with a profit and another one over here with a loss, you don't have to do a management fee or anything like that between the two companies. The tax law said, that's okay, just offset them. No problem at all. But they have to be 100% owned. You can't be 99% owned. But you can't have this company over here owned by a director and this company here owned by another director, or even the same director. They can't transfer. They have to be owned by a parent company to be able to do that. The same thing is if you've got intercompany transactions. There's no GST on that because the tax laws understand that if you've got sales or hire fees between companies, you don't need to charge GST because one gets a credit, one gets to pay to the tax office. So entities in the group don't need to do that. Like I mentioned before, there's asset protection. Separate companies with separate purposes. You have the asset companies over here and you have the liability companies over here. And they're sort of separate because of the different company setup. And like I said, parts of that can be sold off. You might have the New South Wales operation that someone wants to buy. Yep, no problem at all. Here it is. But if it's all part of the one entity, it's hard to sort of pull that out, and particularly if you've got capital gains issues to deal with, if you're over more than $10 million. So you can just say, here, have the company as a share sale. And again, having these different components, this opens the door for all these restructuring, rollover, and small business capital gains tax relief, because you can then sort of have restructure it for the rollover, but then take advantage of the capital gains tax concessions as well. So if you want more information on business structures and stuff like that, I've done a couple of videos in the past on which business structure is right for you, some advanced things. I'm going to be doing some more of those very soon, because that's what I like doing. What I'm finding is a lot of my clients are getting a little bit more sophisticated now. They need some advice regarding this. So holding companies and bucket companies are becoming all the cool things to talk about. That's where I'm going to leave it. Make sure you go and check out my other videos. Hopefully you got a little bit out today. Understand what the difference between a bucket company and a holding company is. And at the end of the day, they're both sort of kicking the can down the road a bit, but they've both got their other purposes. Give me a call if you've got any questions. Go and check out my website. That's really cool, www.12.com.au, and give me an email if you've got any questions. All right, thanks for watching, and goodbye for now.